Hi all, welcome to this tutorial. So in this tutorial, we are going to discuss about the source, stability and trend of the revenue. So as we know, the revenue is one of the key success factor of any business in any industry, in any segment, anywhere. There should be revenue or sales, what you call the sales, revenue. It should be there, or this is the one of the key success factor of any business success. So in the previous discussions, we already covered the ratio analysis. So the analysis or proper analysis or the understanding of the pattern of revenue is very crucial or very important in the financial statement analysis. So now we are covering up financial statement analysis. Out of that, in the last discussion, we already covered financial ratio analysis. Now we are coming into income analysis or revenue analysis. Revenue is a key success factor in any business, any segment, anywhere. But the proper analysis and identification of the revenue, its type, its category, or its quality, it's very important to understand, to analyze the financial performance of any business. So again, revenue is the top line, what we call as top line in the income statement. It's a starting point of evaluation where company's financial health. Once as an analyst, once you have started analyzing a company's income statement, the first thing is the top line or it is the sales where you have to start the financial statement analysis. So the quality of the revenue or its persistence or its quality, stability and its source is very important or is very relevant when we are analyzing the financial statement of a company. Again, revenue should be segmented to identify the dependency, like with the product line diversification. Just assume if a company have revenue only from a single product, that means there is a high risk for loss that revenue. Maybe some product diversion from the customer or any other technological change or invention of new product. All these things can happen in the modern business environment. So the product line specification is one of the key factor which determine the quality or source or stability of the revenue. Then the geography. Geography means if the revenue is generated only from a small geographical place, it's highly risky because if something happened into that geographical location, again it can create problem in the business. Then the customer concentration. Customer concentration means if the all revenue or major portion of the revenue is based from a single customer or only with a few customers, then definitely that there should be a concentration risk, what we call as concentration risk. That means if this business or its revenue is in high risk category because its revenue or its sales depending only on the some very small number of customer or from a single customer. So if the customer decided to shift into another supplier or into any other technology or any other product, so this source or stability of the revenues can be a question mark. So when we are analyzing the source of revenue, all these things, the product line diversification or whether it is from a single product or from the multiple product, then the geography is all the revenue or sales from a small geographical location. Then the customer concentration is the customer is concentrated or customer is diversified with different segments. This analysis has to be happen when we are analyzing the revenue or sales of a company. This is about the source analysis. So when it comes to stability, stability is one of the important factor which determine or stability of the income is determine the stability of the profit, stability of my business success and the financial success. So the stability of the revenue or stability of sales is a crucial factor to determine the business success. Suppose some industries like the defense and defense or utilities or healthcare, it can be high stability regardless of economy. Even if the economy go down, these sectors like utilities, healthcare, or even the defensive industries, what we call the defensive industries. So this can be some economic change or economic instability may not going to affect in these defensive industries. Then the cyclical industries like automotive, luxury goods. So it is normally highly volatile. It's depending on the economic condition. So when we are analyzing a revenue of the company, we have to identify or we have to see its stability, whether this is from a defensive industry or cyclical industry. Then there will be operating leverage. There will be operating leverage. Company with high fixed cost or stable revenue are safer. High fixed cost with unstable revenue are high risk. If you are analyzing a company have high fixed cost, then if the company have higher revenue, then to cover up that fixed cost, then it is normally considered as a safe. But if you are looking into some other condition, the company have high fixed cost, but the revenue is unstable, then it will be in high risk, because if it is high fixed cost, whether it generate revenue or even it is not generating revenue, the company has to pay or need is fixed cost or fixed obligations. So these factors has to be considered when we are analyzing revenue or top line of a company. So first one, what we can factor is the source, or it is from a diversified stock, or it's from a small geography, or the customers are concentrated. These are the key consideration while we are considering the source. But when it comes to stability, if it is from defensive industries or cyclical industries, or if the company have high operating leverage, these all factors has to be considered when we are analyzing the revenue or top line of a profit and loss account or of a company. Then the trend analysis. Trend analysis is a process or it's an analysis which affecting or which is analyzing the trend of revenue over a period of time. Suppose a company have in the year 1, the company have a 5 million. Year 2, the company have a 6 million. Year 3, the company have 8 million. Year 4, if the company have a 9 million. So in this example, we can see that there is a growth trend. So this is what we call it trend analysis, or we are converting this into some percentage, that we are comparing our current revenue with the previous revenue to see that growth, or its earning trend is one of the most important factor has to be considered when we are analyzing the top line or revenue of the company. Then we will go to next concept, that is persistence of revenue. Persistence mean is its current period revenue will occur in future period also. That is persistence. That means if there is a chance to occur a current period revenue in the future period, then what we call there is a persistent or stability, or that earning is a qualitative earnings. So some cases, if the some recurring revenue models, like some subscription based models, it is more persistent, or and there is a high earning quality in this business model, like it is subscription based. Once a customer subscribed for a 1 year, so every month the company will earn a revenue based on that. So that is more stable revenue. But some higher persistent in some based models, like a car dealership or some industrial product or industrial segment, it is not persistent. It is a one time when compared to this recurring model revenues. So when we are analyzing a revenue of a company, we have to consider, or we have to analyze whether this can be a persistent revenue or this is from a transaction based model. Then the switching cost. Switching cost is a concept where we are deciding, or we are considering that customer cost to switch to another supplier. Right now we are supplying to a customer. Suppose if the customer decided to switch from us to another customer, so that is what that we call the switching cost. So normally there is a strategy for companies to increase the switching cost from our company to another company or to the competitor. So which will ensure the revenue persistence. Suppose if we are supplying some specialized material to some companies, so the customer normally they will have higher switching cost. But if you are supplying a common commodity, the customer switching cost compatibility is lower. So when we are analyzing that switching cost or the revenue, we have to consider the customer switching cost as well. Then the market share leadership. Definitely we have to analyze that this company is from a dominant leadership or dominant market player. Definitely, if this is a dominant market player, there should be some sticky revenue or some persistent revenue can happen. Again, there are some negative or red flags also there. Suppose there is a one-time gain. One-time gain means there is a single contract is designed. It is not going to happen, or it is not a recurring model revenue or revenue from sale of a division or a legal settlement. These all one-time gains. Again, if this is reported in the as a revenue, this is a red flag for the company, because this revenue is not going to happen in the next years or next period. Or channel stuffing. Channel stuffing or is a practice. There are some buyers or some practice. There is a practice. It is by selling or buying the material wholesale to see the year-end bulk sale figures. Maybe if you are working in a sales department, you want to show a good sales at the end of the year. What you do, you have to sell to that material to a distributor or to a customer and agree individually to return back it in the next year. So if this is the process of channel stuffing. If there is a channel stuffing in the company, that earning may not have that quality, or it is not a low quality earning. It is a low quality earning. That means the same material can return in the next period. Once the year close, the same income can be returned back. So this is not a qualitative income, or which have very low persistence. Then the aggressive discounting. Some companies, what they will do to create a very short-term demand or very short-term sales, they are engaging customers and then giving more discount to customers without considering its long-term financial obligation and future revenue potential. So if you are doing aggregate discounting, you are throwing or you are challenging the market, and definitely this will reduce the future earning potential as well. So this is a negative signal which will affect the earning persistence. So what we discussed here is earning persistence. Earning persistence mean there is some positive signals are there, like recurring revenue model, the customer switching cost, and the market share leadership. And there are some red flags also there, like one-time gains, channel stuffing, aggressive discounting. If these companies generated revenue through these red flags, if there is a red flag in that company, that revenue may not recur or it persist in the coming years or coming periods. So let's move into next concept, that is relationship between revenue, inventory, and receivables. So definitely, normally what will happen, if the revenue, if you have to increase the revenue, definitely you have to increase your inventory, because you have to store more material. And definitely, if you increase your revenue, your receivables also increase. This is a commonly accepted concept. So if you want to sell more, definitely you should stock more. And definitely, if you sell more, it will create more receivable as well. But it should be proportional. This concept telling these three things, revenue, inventory, and receivable, should be proportional. Suppose if the revenue increased to 10%, inventory also increased to 10%, and receivable also increased to 10%, which is ideal and which is a normal scenario. But if revenue increased only 10%, inventory, you have inflated inventory more than it increased to 50%, and receivable increased to 75%. That means there is no quality for that revenue. That means there are some money, so some bad sales happen there. That's why the receivables are inflated. Again, you are not properly managing, or you are not properly managing the inventory. That's why the inventory is inflated there. So it is not proportional to the revenue or sales. So the first thing, revenue versus account receivable. Definitely the revenue has to be linked. It should be proportionally increased with the account receivable. The account receivable has to be proportionally increased with the revenue, not more than that. If it is more than that, it indicates that the company is extending credit to low quality customer just to record a sales. That means it is not following proper credit control procedure, and it is just extending its credit to customer without proper documentation or without proper control. So it is it is considered as a low quality receivable or low quality sales. So it is just a recording of sales. It is not a qualitative sale. Or it indicates that it is struggling to collect the cash. Suppose if the revenue grows 5% and the year account receivable grow 25%, then it indicates that there is some liquidity crisis or fake sales happened here, because if revenue increases to 5%, the maximum increase can happen in the account receivable also 5%. It should be more than that. So in this case, you can see that it is increased to 25%, which indicate that there are some low quality sales or fake sales, or the company is not following the proper control over credit, and just show the sales, it is extending the credit to customers. So this is a low quality revenue. Again, we will see the relationship between revenue and inventory. Again, as we discussed, it should be related with the inventory also. The revenue should be related with inventory also. Suppose if inventory grow faster than revenue, which indicate that inventory burn. This suggests products are becoming obsolete, or that the company is overproducing to spread fixed overhead cost over multiple units. Again, which is artificially, it is low. There should be some inventory obsolescence can happen. There should be some inventory losses can happen due to this process. So again, if the inventory is increased proportionally than sales, it is a red flag to the company or a red flag to the financial statement analysis. Then let's move into the next concept, that is revenue recognition. The revenue recognition determines when, how, and how much revenue is recorded. Under a 5-step model, revenue is recognized when control is transferred. Normally, there are different scenarios can happen in different. Suppose if you are running a normal business or a retail shop, it is pretty easy to record the revenue, because once the sales is happen or customer purchase something from your shop or from the supermarket, the sale time you can record the revenue. Suppose just look into an example. If you are running a rental business, one of your properties taken by a customer, one of the customer for 1 year, just assume as an example. So they agreed to pay the monthly rent. What we agreed, it is $1,000. So and they paid 12,000 as advance. So and at the beginning of the year, you cannot recognize this 12,000 as your revenue. This is not your revenue at the beginning of the year, because this performance that your service still not provided. So in this case, what you have to do, you have to record this as unearned revenue, and you have to distribute this 12,000 monthly as 1,000 to each month. Once the performance is obligate or the rental period is covered, after you can transfer this 1,000 by month as a revenue, or you can recognize this 1,000 as the revenue. So this is revenue recognition principle. The revenue can be recognized only once you performed your obligation. Here it is your obligation to provide that rental service. So if you provide that rental service, then you can recognize this revenue periodically, not at one time. This complete advance you cannot recognize as revenue, because it is still the performance not completed, or the performance obligation is not completed. So the first thing in the revenue recognition is to identify the contract. So in this case, the contract is the customer is agreed to pay 12,000 as you advance for the next 1 year contract. So here first one you have to identify the next thing you have to identify or remark the performance obligation. Here your performance obligation is to provide that rental service to that customer. Once you provided that rental services to customer, then only you can accept or you can recognize this as revenue. Then determine the transaction price, which is already mentioned in the contract, that is 12,000. Then allocate price to performance obligation. So these 12,000 you can allocate to each month based on the performance obligation. So you can equally distribute this 1,000 to each month. So if every month, 1 month performance obligation you completed, that time only you can recognize as revenue. So this revenue recognition policy has to be considered, or it has to be playing a major role when deciding or the determination or what company is recording as the revenue. So this revenue recognition policy has to be reviewed once an analytical guide doing the financial statement analysis. So in this case, what you can do, you can recognize the revenue when the obligation is satisfied. Suppose you provide rental services for the first month, then you can recognize that amount as revenue. Once the second month finished, then you can take the second month $1,000 as the second month revenue. So based on the performance obligation only, you can recognize revenue into your books of account. Again, there are some impact of policies of financial, like point in time or over time. Suppose if there is a construction company, it can normally, what can happen, it should be based on percentage of completion. Suppose there is a contract signed with a you are running a construction company, and you are signed a contract with your customer for 1 million. If you there should be some performance obligation in the contract. First thing, if you complete 50%, they will recognize, you have to recognize as 50% of your contract value. So there should be some performance obligation in this long term contract, or in the long term contract in the revenue recognition policies. Again, gross versus net reporting. Some cases, what can happen, there are some, like, just assume some websites, they are providing the ticket booking services. If you transfer your ticket money to that agent, they cannot recognize that full amount as their revenue, because they are acting as a commission agent only in this business. So they cannot report that complete amount as their revenue, because they can report only, or they can consider, or they can recognize their commission or their part only as revenue. So there are various, depending on the industry, there are some different considerations are there. So what here it mean that in the financial statement analysis, you have to see which revenue recognition policy this company is following, and again it is the performance or the performance obligation is completed. You have to make sure the performance obligation is completed to recognize a money or a advance or a cash as revenue. Otherwise, it is just only an advance, not a revenue. Just look into some practical example. Here, software firm report 40% of its annual revenue in the last 2 weeks of December. So, as an analysis, this suggests that low persistence and potential channels stuffing. Analysts should check the allowance for sales return in the following quarter. So that means if the sales increase temporarily, there should be a big chance to return that sales also. So this factor has to be considered. The earning persistence and earning fluctuations also has to be considered when we are analyzing the earning quality of a company. And let's see that. Just look into this example. You see the revenue is increased at 10%, and the account receivable 60% increase, inventory increased at 75%. So this is a major red flag. Revenue only grew 10%, but the company is tied up 6% more account receivable from the customer and 75% more unsold stock. So in this case, the earning quality or quality of earning is low. So if a company telling that we are increased sales this much proportion or this much percentage, so the meantime parallelly you have to analyze what is the impact on its account receivable and what is the impacts of its inventory. These factors also has to be considered or has to be come into equation to see the real earning quality. So what we discussed today is the earning quality. Again, the revenue quality and persistent. High quality revenues recurring like subscription and operating in nature. Low persistent occur when the revenue is driven one time gain. So if there is a subscription or contract model revenue, that can consider as more persistent revenue. But if a revenue is from a one time gain, Again, that should be a big red flag there. Then the receivables warning. If account receivable grows significantly faster than revenue, it can indicate decline in earning quality. Then the inventory red flag. When the inventories grows, outpace revenue growth, it often signal dead stock or obsolescence or management of overproducing to artificially lower unit cost and inflate current profit. Then the operating cycle conversion. Then if you are doing analysis, the operating cycle has to be considered. That means how many days the inventory, the material takes in inventory, and how many days the receivable stake or the sales stake in receivable has to be considered to see this inventory or the sales is collecting and it is converting into cash effectively. Then the revenue recognition. Revenue is normally recognized only once the goods or services are transferred to the customer or that specific performance obligations are completed. Then the trend source and reliability. If there is a companies have a more stable income for over a period, it's considered as a more stable revenue. If there are some negative trend or unstable income showing in a company's financial statement, it is considered as a red flag in the financial statement analysis. So this is about today's discussion. If you have any doubt or you need any extra clarification or any of these topics, please ask me on the comment section. Thank you for watching this video.